The local economy is officially out of recession. Gross domestic product grew by 2.2% in the third quarter on a quarter-on-quarter basis. It follows the economy contracting in the first and second quarters, which by definition meant it was in recession. The main drivers of the growth for the third quarter included manufacturing, transport and the finance sectors. The latest outcome actually beat expectations. While most economists expected that South Africa would come out of a recession, the average growth expectation was 1.6% for the third quarter. On a year-on-year basis, economic growth rose by 0.5%. On the release of the news, the rand firmed by as much as 10 cents against the US dollar. The currency had been firming slightly ahead of the news in anticipation of the positive outcome. Rolland from Econometrix joins me for more on this in studio. Thanks so much for your time on SABC News. This rand firming ahead of this announcement, does it have to do with the expectation that we were going to come out of a recession, or does it also have to do with how well emerging markets are doing and international factors like the dollar?
Yeah, thanks for having me on. I think it was probably a combination of the two. It was widely expected that we were going to exit the recession, and many were just trying to see, well, how strong would growth be? We knew manufacturing was up. We knew the trade, wholesale and retail trade was up. So it was just a question of how much. And I think the 2.2% maybe surprised many on the upside. And this would be a domestic factor that caused a bit of rand strength. But it also is important to look at it within the context of the global economy. We've seen emerging markets have started to quieten down in terms of the currency crises that we saw in Turkey and Argentina a couple of months ago. We've now entered a sort of lull where in this type of period emerging market appetites return, and this is probably a reason for a lot of the internationally driven rand strength, and then we combine that with the domestic factor and we have it what we have now.
Okay, we saw that transport, finance and business sectors were the driving contributors in the growth this quarter. Can that be attributed in any way to President Cyril Ramaphosa's investment drives or the job summit, or is it too early to say that those are the effects?
I would say it's probably a bit early to quantify the effect of Cyril Ramaphosa's words and his actions on the real economy as a whole. We need to start, firstly, these kind of things we need to look at in terms of confidence measures. PMI coming out, manufacturing PMI coming out yesterday, good recovery, suggesting that maybe the manufacturing sector is a bit more positive. Now, from there, we need to then see, well, is the manufacturing sector starting to produce more? Which we'll probably only see in the next quarter if confidence in the PMI continues. Of course, the problem with this is, well, we've just seen load shedding come about again. Now, whether this is something that stays with us is going to determine how much manufacturing can expand. We saw manufacturing expanding by about 7.5%. Is that the beginning of green shoots, or are you saying we still definitely need to wait even with that figure? Well, we need to consider what it comes out against, the context of it. I mean, you remember we calculate GDP as a quarter-on-quarter. So how we calculate the recession was Q1 against Q4, Q2 against Q1, and then Q3. So you're kind of following a historic a line where it depends on what its previous figure was. Now, based on this, we've had 2 periods of consecutive contraction, which means we're coming off a low base. So to say that the uptick is a recovery for sure, I would say we need to maybe wait until at least the beginning of 2019 for this to say, yes, we are in recovery. Okay.
Now, looking at the growth from the business and finance industries in quarter 3, I just want to find out, if you think South Africa is doing enough to move away from a reliance on primary sectors and moving towards more tech, commerce and finance in order to ensure that our economy grows by more than these small percentages that we're seeing over the last few years?
I think in this regard, moving towards tertiary, what you sort of call the high-skilled, capital-intensive sectors is certainly one that we should strive to. And I know this is something that government does strive to achieve. Remember, reliance on things like agriculture and mining and manufacturing to a degree, these all are dependent on, firstly, commodity prices and indirectly on the performance of the rand. So if the rand is very weak and commodity prices up, this typically benefits our exports. Now, this is fine when commodity prices are high or the rand is weak and we can benefit from that, but the danger with this is this moves in cycles, and when commodity prices are lower, like we saw since after 2010, then our sectors really start to struggle, and achieving good returns, achieving good profits and reinvesting in those sectors starts to stutter. Whereas in the tertiary, the sort of high-skilled, capital-intensive, these are typically not reliant on commodity prices, and so they typically perform better independent of how the economy is doing.
When we're speaking about this 2.2% growth, we're saying South Africa's economy is out of a recession. There's almost a celebratory air to it. Is there anything to celebrate, seeing that we're quite far away from our 5% growth target and there's still so many inequalities in South Africa? Is this really something to celebrate, or should we celebrate the small wins while still looking at how much we still have to do?
So I think we need to celebrate, and let's call it a restrained celebration, because firstly, yes, we are at a recession. Now this is going to go a long way to staving off a sort of potential credit downgrade, which many economists believe will put us firmly on a slow growth path for the next 5 years. So in the context of that, I would say it's cause to celebrate in that we are likely, Moody's or rating agencies might upgrade our rating, or they might withhold downgrading us fully. So that's the positive. The negative of this outcome is, well, if we look at the numbers, we see firstly in the tertiary sector, government output increased. Now, government output increased because it increased employment in the size of the civil service. We know that Treasury and government has been trying to reduce the dependence of the fiscus on the public sector wage bill. So this is a little bit of a concern. The other thing, of course, if we look at the expenditure side of GDP, we see that investment was one of the contractionary items reported. As we saw, Cyril Ramaphosa has had his investment summit. We want to see investment starting to grow again, because when investment grows, our potential output grows. And with this contracting, it's not necessarily a good sign towards addressing the structural weaknesses like health, like education, and then also ultimately getting to the policy certainty of things like land expropriation.
Thanks so much for your time on SABC News. Sam Rolland from Econometrix joining us to give us more of an insight into those GDP figures that just came out.